All right. All right. We are here with Jehil, who is Mahak's brother from my fifth period class. Man, thanks so much for being part of our class today.
Yeah, of course. It's a pleasure.
So you went to Coppell. You went to Coppell ninth and 10th grade, and then you went to the math and science school for 11th, 12th grade, correct?
Yes, I went to the Texas Academy of Math and Science in Denton.
Gotcha. And so now you're at Columbia University. And what year? What year are you there?
I'm a junior, so I'll be graduating in spring of 2024.
Okay, awesome. And your degree is in what?
Computer science and math.
Okay. And what's the hardest thing about college?
Time management's probably the hardest thing. In elementary, middle, and high school, you got assignments every day, and you kind of have to finish those, and your teacher will get on you. Over here, no one's really going to get on you about those things. You're going to have very few assignments, a lot of your grades based on exams. So you got to make sure you're on top of your lectures, on top of reading your textbooks, and all those things because your teachers or your TAs are never going to bug you about getting your work done.
Yeah, yeah, for sure. And if you don't understand something, you need to go to tutorial help, and that's all like self-driven, right?
Yeah, yeah, I think that's another underrated aspect of college where if you've been smartest, your whole life in school, you're now surrounded by as people who are as smart as you or smarter.
Yeah,
So you kind of have to swallow your ego and go to office hours and ask for help,
yeah.
even when you might think you don't need it.
Especially at Columbia. I mean, holy
Yeah,
cow!
I mean, yeah,
Like that's
there's
the
so many other
mecca of
smart.
smart kids, right?
Yeah, there's so many other smart people here. It's quite a humbling experience to meet all those people, see all the amazing things they've done in the past and continue to do. So it's you get to learn from them, and then hopefully that inspires you to do something great on your own as well.
You know, my freshman year in college, walking down the main area there to lunch, and I get a credit card application, and I fill that thing out, and I get my Reese's peanut butter cup king size that they gave me for filling it out. I get that credit card, and I maxed it, and I just made horrible financial decisions back in 1993. There weren't a lot of people out there giving us financial advice. Have you felt the same kind of pull toward debt, credit cards at Columbia?
Um, so I would say probably more so than other college students, just because of the fact that I live in New York City. Uh, People often go out on weekends to restaurants. I think the cost of living here is just higher, so food costs a lot more, experiences cost a lot more. So I feel like naturally people going out will have you go out as well. But I think as a whole, I don't think I've had a problem with that. I've worked two internships, this like one internship this past summer and one the previous summer, and I'm working right now. And I've had my own credit card for a while now, and I usually pay off my own statement. So
Yeah.
I'm usually able to keep things in check for the most part and make sure that I'm not going overboard. I have like Credit Karma on my iPhone to make sure my credit score is doing okay. So I usually keep those things in check, but like in terms of actually spending, I think like probably I do end up probably spending a bit more than the average college student just because of the fact that I'm in New York.
Yeah, I mean, I was in San Diego, and going to Los Angeles was crazy expensive, and it was hard to not want to spend. I mean, do you have friends in college who have got into financial problems at all, like credit card debt or anything? I mean, getting a pastrami sandwich in New York City is probably $25. Like it's so, I mean, everything's so expensive there.
Yeah, I think one of the things here is like there's a wide array of students. There are students that come from different backgrounds. So there are quite a few students here who come from very wealthy backgrounds and
Yeah,
they're able to afford certain things, but they also have friends who might not be able to afford those things. And
yeah,
so some of those people might get pressured into going out with those friends because they're all doing these nice things,
right.
going to nice restaurants. So like I've had like one or two friends tell me like, hey, like one of my friends on the fencing team and his friends are pretty wealthy and like he feels pressured to go out with them even though like he might not have the same financial capability as his friends to spend. So that's always something to be wary about, like your friends might have different capabilities than you. Even as you get older, like your friends are going to have different occupations than you, so they're going to make different amounts of money. So if they make more or less, you kind of have to take that into account when you go out with them and make sure of those things. So I think that's just, yeah, that's more of the issue at Columbia.
Yeah, and you would reach out to me about looking to do a financial an app or some kind of program for students where they learn how to invest and all that kind of stuff we talked about before. And I'll show you my thing here in a second as well, which I'll have the kids do. And but what is your basic overall thoughts on how should people invest maybe in their young age when they get older? What are your thoughts?
Yeah, of course. I think in general, like uh passive investing in terms of like being thinking about the long term rather than short term is probably the way to go. I think recently with like during COVID, a lot of retail investors got into day trading, making a quick buck off of companies and stuff like that. I think sure you might be able to do that a couple times, but definitely not sustainable over the long term. As you can see right now in this market, everything is dropping, so very, very difficult to kind of gauge how things are going to go. But in general, though, if you're younger, I think you can definitely afford to take more risks
Yeah.
in terms of how you invest. Not be irresponsible or anything, but if you see a stock that might have higher upside uh, due to an actual viable reason, might be worth investing, even though you might take a loss in the short term.
Yeah.
Like if you think you don't need that money anytime soon, you can just park that money, kind of just track it as you go, and then forget about it and let it grow over the long term. Now, obviously, as you grow older, you might want to move towards like more blue chip stocks that are established.
What
They're
is
kind of
that?
yeah. So those are some of the biggest stocks in the market. They represent the majority of the market. So typically safer. They've been established over a long period of time. So the American people and economy have a large element of trust built up in them already. So
Yeah.
usually a safe bet. People don't think they'll default or basically go under. That means, or they don't think that the stock will drop or they'll have significant reductions in profit over a period of
So
time.
what's the first company that comes to mind for a blue chip stock in your mind?
I would say Apple,
Okay.
probably the biggest one. I think they have the largest market capitalization, so that company is worth the most right now on the market.
Yeah.
Obviously, they've been established for a long period of time. They've shown time and time again that they can deliver a profit. And I think the last reason is that Warren Buffett, who is also a Columbia alum, he's a legendary investor,
Wow.
and he typically uh, invests in stocks that are pretty safe. He's a big, big supporter of Apple over many, many years.
Right. And the dividends are great. So yeah, I mean, Apple for sure. Interesting. Okay. So, but what you're saying, like, to invest in, like, to not be a day trader, to not be putting short positions on all sorts of things, to not be super risky, man. Jehil, that's not sexy. That's not sexy at all. That's not like, I mean, index funds, mutual funds, not super like gonna go brag to your friends that you made, 7% on a year, whatever. Well, let's say that Mahak came into $10,000 and she wanted to put it in the market. Where would you tell her to put it?
Yeah, I mean, I think probably 90% of it, I would tell her to put it in a combination of like ETFs and pretty strong stocks that she would believe in. So obviously the biggest ETF is SPY, which covers the S&P 500 index, which is like, the 500 like the largest kind of representative of the general American economy companies. And that would probably make a good chunk of the investment. I would say like 20% or so. And then like rest of it, you can look into other ETFs as well. So like, if you want to maybe look at gold or copper, like they typically tend to be good hedges for inflation. So right now inflation is high, prices are high. Gold is typically known as an inflation hedge. Um, Obviously, like if you do research into a specific sector, so like let's say you're very interested in technology stocks, there's the ETF QQQ. There's ETFs that follow real estate companies, ETFs that follow like industrial companies. And so if you do research into those things, I would encourage you to like look into specific sectors. And I would say since Mehek's young, she can also afford to like look at riskier companies, you know, your Ubers, your Teslas, Snapchats, those kinds of things, your unicorn tech startups that you know are kind of volatile because or they might not be making a profit right now, but they're very high growth companies. And then you know, especially right now when things have dropped so much, if that company is has intrinsic value, um, it could definitely come back up when times are better again.
Okay.
And then
So,
like
okay, go ahead.
yeah, and then like a small portion of it, like I said, like it can kind of be dedicated to like day trading crypto or whatever. I think it's you can learn a lot from that. I would not dedicate a large portion of money to it. It's like money that you basically think of it as like, okay, that money's gone. I'm never gonna see it again. That's how you think about that money. Now, if you make any money off of it, that's just kind of
Yeah.
icing on the cake. But the way you kind of think about it is like, hey, I'm okay with it if this money's gone. So that's the amount of money you should be putting into day trading crypto or those kinds of very volatile
So if you
um,
want to put all 10 grand in Dogecoin, I guess that's what we're going to do. Yeah, I don't know. So in a couple, you know, they're gonna be picking stocks, they're gonna be picking cryptos, they're gonna be picking ETFs. As you can see here, here's the list. They're gonna be investing 100 grand total. Um, what would be, and by the way, the championship team will be decided by who has the most money by December 15th. So overview, maybe not specific, but overview, what strategy should a team have when picking stocks, crypto, and ETF and mutual funds that are in a 2-month period of time?
Yeah, no, I think that's definitely a great question. I think what you should be looking at is like how a company has been doing the last 2 months. I think looking at the performance of that company over the last 2 months and seeing like what is the possible reason it's gone up or down, right? You kind of look at facts about the current economy. So I think obviously I'm sure the students don't have an extensive like macroeconomic background,
No.
but I think like basic things like just researching like, hey, you know, in like things about inflation and interest rates, those are probably two of the biggest movers of the market. And there are certain sectors that are more resistant to those things. So,
Yeah.
like for example, technology is not resistant to those things because when times are tough and people are losing their jobs and things are getting more expensive, they're going to be less likely to buy newer pieces of technology. For
Yeah.
example, the new iPhone just came out. There aren't any major improvements in the iPhone. And when times are tough for people in America, they're not going to go out and buy $1,000 iPhone that has incremental improvements, right?
Yeah.
But there are certain other industries out there, right? If you look into, let's say, the food sector, or if you look into like essential items like, let's say, toiletries or cleaning items, things like that, that people might be using on a daily basis, those might be something to look at because it's like, hey, well, even if prices are going up, these are things that people need on a day-to-day basis. That's those things aren't going anywhere, right?
Yeah. Right.
So that's how I would kind of evaluate it. Another underrated aspect is, I guess this applies more to like commodities, especially like right now when inflation is high. So, you know, people aren't looking to put their money, um, you know, inflation is very high right now. So people aren't looking to spend their money exorbitantly. So typically, like they park their money in something like gold or silver or something like that, which has
Yeah.
kind of retained its value or even grown over time because it's a scarce material. There's a limited quantity of it in the world,
Yeah.
but people have continually wanted it. There's a high demand for it. So if you look at different commodities, you look at copper. Copper is something that's used in everything from electronics to building homes, uh, to like cars, all of these essential items that we now use on a daily basis. If you like look into the supply of copper versus the demand of it, supply of gold versus demand of it, you can maybe analyze where the price is and where it could go.
Yeah.
Now, if let's say for copper right now, the price is, almost dropped by a third since March, where it was at its like record high. That's a pretty significant drop in just a couple months. But if you kind of look at it, um, yes, demand's expected to be low, but supply is also at like record low levels. So if you kind of think about it, you're like, okay, well, copper is kind of needed by everyone. So even though it's down right now, there's going to be a time, maybe in let's say 2 months, like it's the holiday season, right?
Yeah.
People are going to be buying gifts for uh, family members and friends, and a lot of
Right.
times it happens to be electronics or things of that nature. So maybe at that point, demand for copper is going to go up. The supply is still very low, which means that the prices go up, right?
Right.
When people want a lot of something, but there isn't enough of it, people are going to pay higher prices for it. You right? You kind of
Yeah.
think about it like an auction. You have a price, you have an item. A lot of people want it. They keep bidding it up and up and up, and the price keeps going up. So that's how you kind of think about it. So you think about like broad. You don't have to look at the company itself, but you think about the broad economy. Like, okay, is like holiday season coming up? What are people's behaviors going to be like? Are things expensive? What does the supply and demand going to be like? You kind of think
Sure.
about those things broadly.
And also like I mean potentially like the war in Ukraine with oil issue situations in Russia and people want to travel.
Right,
People still want to see their relatives despite the fact that their OPEC is not sure what the production
right.
or prices are going to be. So like I mean it's interesting in like ETFs and we'll get into that a little bit more about what those are, but like trying to find or maybe investing directly into Chevron or direct investing directly into Walmart or whatever. Let me move on here to our a couple things here. First of all, this is going to be, and I'm going to do this as a speed round, by the way. So I'm going to set a timer here, so I'll make sure I don't go too long on any one of these. We'll do 1 minute on each one of these slides. Speed round in just 1 second. But this is Timmy, and Timmy is our neighbor, and he's 14 years old. He's super eager about wanting to learn about investing, and he's come to you. And these are all the terms you've learned on the first week of school or whatever. And these are things that they're going to be trying to figure out. How do they influence Timmy this week on what maybe Timmy ought to know? What's the most important thing Timmy ought to know? So first slide here for investments. How would you characterize or how would you explain investments to Timmy?
Yeah. So an investment is anything you're kind of um, purchasing that you expect over a time period to increase in value or give you some benefit. Because obviously you look at stocks, real estate. Now it's not guaranteed. Or
Yeah.
it's I would say it's typically not guaranteed. Maybe things like treasury bonds, which are government bonds. So basically, the government's borrowing money from you, and then
Yeah.
they'll pay you back with interest at a later rate. Those probably aren't going to go anywhere, but obviously you're going to make less money on them because there's less risk. But also, I encourage students to kind of think about investments in other ways too, not just financially, but investing time in school, for example, that's a big
Yeah.
investment for your future. Anything that you put time or any kind of resources into and could potentially give you benefits in the future, I would consider that an investment.
Okay. Let's move on here. Let me set the timer again. Securities. Oh, how would you define this to Timmy?
Yeah, so I would tell Timmy that securities are a type of investment. So securities are typically, stocks, which represent ownership in a company, or bonds, which represent the debt that you own in a company, and then the company will pay you back for the amount that they've borrowed.
Yeah.
So, but I guess the difference between securities and other investment is that they're very easily tradable on an exchange. So that hey, if you want to buy a stock, you can go on Robinhood and buy or sell right now. Same thing with
Right.
bonds, very easy market. You can't do that with real estate, right? If
Right.
you want to list a house, it's going to take a couple weeks, if not a couple months, to kind of find buyers, get all that paperwork situated and actually finally sell the house. Same thing
Right.
goes for businesses. If you want to sell or buy a business, take some time to do the due diligence necessary. Securities are a very quick way of owning or a company or owning debt that is an investment.
Okay. And you know, it's interesting. We're coming into some inheritance here from my mom's estate, and one of the guys was talking from J.P. Morgan. He's like, because of the way the market's so volatile right now, he's like, I'd recommend a money market account. Like, just put it in there and 4%. And it's like, at least you're getting something, and you're not like he's
Right.
recommending to all of his millionaire. He deals with people who are 25 million and up. He's like, that's where I would go with that money. It's interesting, considering like the market's been so great for so long. Okay, third one here. Rule of 72.
Yeah, so I would tell Timmy that the rule of 72 is just an easy way for him to kind of find out how long it would take for an investment to double. So if he has like bonds that are returning, let's say 3 to 4%, he just does 72 divided by whatever the rate of return is on those bonds. Let's say 3.5. And that's how he would get what the time it would take in years. So if it's a 3% annual interest rate of return, that's how long it'll take for him to double his investment. So it kind of helps him gauge, like, okay, this is how long I want to kind of double my money, right? So he can look at the different rates of return. So, like, how safe do I want to be? Obviously, this doesn't tell you the risk element, but kind of gives you a nice idea of how long it would take. Now, if your return rate of return annually is crazy, if you make 10% a year, you'll double that money in like 7 years or something.
Okay, very good. All right, the next one here, diversification. How would you describe this to Timmy?
Yeah, so I would tell Timmy, if you're very interested in investing, diversification is very important because when the economy is doing good, sure, like everything's doing great, but there are times when certain sectors are going to be doing bad. Right now technology is doing bad, but other sectors might be doing well. So
Hmm.
what diversification allows is that, like, if you do end up investing your money, you're not losing your money in one entire. So if one sector goes down but another sector goes up, that allows you to kind of minimize your losses because there are cycles for all of these sectors.
Hmm.
Sometimes tech does well, sometimes energy does well, right? So
Yeah.
that kind of allows you to have a steady rate of return and not experience huge drops in your investment. And it might be a little slower, but it's better over the long run because it compounds, which we'll talk about in one of the next slides.
Yeah. But Ben, diversification, it's not sexy, you know, that's not super like, you know what I mean? Like I want 10x return on my Bitcoin, right? I mean, and that's what our economy's been feeling. All right. How would you explain investing in a bear market to Timmy?
Right. So this kind of builds off of diversification, looking Uh, I think this kind of starts off whenever you start investing, just always look to diversify. So, like, even in a bear market, you have your bets hedged in a way that you kind of have a little bit in everything. So when stuff starts to come up, you're doing good, but at the moment, some of the stuff that's doing okay, you're also doing all right. But I think more broadly, investing in a bear market, you look for safer things. You look for things that might have intrinsic value, providing more value to the American economy, that have been there over long periods of time, might just be undervalued. So, like, Apple has been a mainstay for a long time. Their stocks kind of dropped. They have so much cash, I don't think they're going anywhere. Maybe it's a good time to buy that. But another company, like, let's say Snapchat, maybe not great. They're probably not getting investor funding. They have competition from other social media. So maybe not, because their whole stock has been just built on growth of users and people being enamored by,
Yeah.
oh, it's Snapchat.
Right. And it's interesting because Warren Buffett's all about buying, you know, investing in the bear market. Like it's that he's been like one of the most notorious people. When everyone's selling, he's buying because he wants to get a deal. I took my students to New York a few years ago and went to Wall Street and saw the bull. What does Timmy need to know about investing in a bull market?
Yeah, I mean, I think the fundamental value of investing applies here. But obviously, in a bull market, you can probably afford to take some more risks. You know, they say that everyone's a genius in a bull market. So typically, if you pick a stock probably means that other people have picked it too. So
Yeah.
like other people are doing well too. But yeah, you can afford to take more risks. But obviously, a bear market can strike at any time. No one knew the economy would be the way it is
Right.
right now with the stocks dropping like the way that they are. But I think investing in a bull market kind of looks like you're looking at high growth stocks. People are looking for things to kind of even push the economy even further higher up, and they're not really looking to save it. Whereas in like bear market, they're more defensive. They just want to save what they have. Whereas bull market, companies are spending, so they're spending on research and development. They're hiring new employees, so that's what that kind of looks like.
Okay. And last one here, last but not least, compound interest. What does Timmy need to understand about compound interest?
Yeah, so compound interest versus simple interest means that, hey, if I invest $100 and I'm making 3% interest, so simple interest means that every year, let's say my rate my interest is annual, so every year I'm making 3% off the $100. That's what simple interest is. So the first year I'll make 103, then another $3.
Hmm.
How, but compound interest means I'm making 3% off the previous amount. So I have $100. First year I make $3, so that's 103. Next year it's 3% of 103, so that's a tad bit more than $3, and that keeps going and going. Like those incremental things keep adding up, and so not only does that apply to interest, but that applies to the rate of return on stocks as well, right? If you have money that's going to keep building on your current amount, you're like 25% off the current amount. So that also keeps compounding over time. So that's how you
Yeah.
kind of think about it. And so it might not look great initially, but if you're in it for the long run, you can see that the graph ramps up a lot after
Yeah, it
a long
does.
period of time. And that's how Warren Buffett's made his money. He said compound interest is an investor's best friend if you stick with it for the long term.
So if these are your options to help Timmy, now the teams have already drafted at this point while they're seeing this. So you're just kind of making them feel good or bad about what they pick. Which one of these do you think is the first thing, or maybe not the first thing, but the most important thing that you would want to teach Timmy about investing?
Yeah, I think probably diversification, probably the most important one. I think obviously like knowing what investments and all are important, but I think like even if you might have a little less knowledge, I think just having a wide array of investments is just generally good, and that'll just help you invest in a bear or bull market,
Okay.
have consistent returns, and yeah, you won't have to like worry too much about, oh, what's my rate of return. If you're diversified, you'll probably make a consistent rate of return. And that also diversification, what that helps you do is like do actual research into the companies to evaluate like, hey, is this company actually good? And so you'll be able to see like, okay, this is kind of what the rate of return I'm looking at. And yeah.
Okay. Awesome. Let me how do I unshare the stuff right? There we go. Well, man, Jehil, man, I really appreciate you coming in today and talking with my students. This is great stuff. I know they like to listen to me, but they also like to listen to someone that's maybe closer to their age and hear all the great things about investing and hear all this stuff. I mean, this is certainly super helpful. Thanks so much for coming in.
Yeah, of course. No, it was a pleasure. I hope you guys really enjoyed this presentation. And really hope you guys learn a lot from this class because Mr. Simpson just seems like an amazing teacher.
Well, thank you, sir. Appreciate it.